Good evening, everyone. Welcome to PersonalFN's Web Summit. Is gold rupees 75,000 around the corner? Gold has scaled to a new all-time high. It is well over rupees 50,000 per 10 gram. This is nearly a 28% jump since May 2020, the time we did our last webinar on gold. It's a gold rush out there. The precious yellow metal has witnessed an incredible rally so far this year. In this exclusive summit, viewers, you will learn why are gold prices surging, where are gold prices headed, and is this the right time to buy gold? Perhaps the year 2020 will also be known as the year gold shone the brightest. But the question is how you can profit from all this. My guest today is Chirag Mehta. Chirag is a senior fund manager at Quantum Mutual Fund. He manages the Quantum Gold Fund and Quantum Gold Saving Fund, plus a few other schemes. Chirag also has to his credit an MMS in finance. He is also a chartered alternative investment analyst, one of the few in India, and CityWire chose him as one of their top 40 under 40 fund managers worldwide in 2017. His views on gold are extremely insightful. He is a true guru on gold. This is why he's widely interviewed and quoted by the media. In this web summit, join Chirag in conversation with Ghazal Jain, his associate fund manager for Quantum Gold Fund and Quantum Gold Saving Fund, sharing views on the benefits of investing in gold during these unnerving times. Over to Chirag and Ghazal for their insights.
Thank you, Ronak, for having us here. So without keeping our viewers waiting, let's hear about gold's incredible rally. So over to you, Chirag.
Thank you, Ghazal. Thank you, Ronak, for having us. I think it's of interest to everyone that gold prices are hitting new highs almost on a daily basis. Where is it headed? What are the factors driving it? Is it fundamental or is it a kind of bubble? I know investors will have many questions on their mind. So let me run through some slides and tell you what we are seeing in gold and what's driving that. So there are four reasons that we could list down to tell you that why gold prices are headed higher. What are the factors if gold has to go up? These will be the four factors or four reasons that will drive gold higher. So number one reason is the impact of COVID-19. We all know it's an unprecedented crisis. The health crisis snowballed to the economic one. We have all seen lockdowns that we have never seen before, even imagined before. And it is having its own toll on the economy across the globe. It's not only in India, it's across the globe. There is a very disastrous situation at hand as far as the economy is concerned. So let's see how this has impacted the global economies. So 2020 is essentially a washout year. Global world has slipped into recession. We are going to see significant deterioration in growth rates, rather degrowth is what we have at hands. Global economy is, as per IMF projections, is going to decline by very close to 5% this year. So instead of what growth numbers we used to see, like 2, 4, 5%, it's going to be -5 this year. Advanced economies are going through a bigger toll. They will see more declines. Emerging market economies also will not be unescaped because of this crisis. They will also slip into recession. Even if you see India growth rates, it will be closer to -4, -5%. Those are the estimates that are coming out. Longer the lockdowns, longer the economy takes time to come back on its feet, these rates will deteriorate further. And next year, people are talking about a very sharp rebound. It's like a V-shaped recovery. However, it may not be so V-shaped. If you see, initially, it may look like a V-shaped recovery, but it will take its own time to recover because this crisis is really unprecedented. The kind of damage to the economy is very, very severe. And therefore, we think that it will take time to recover. Another factor that will stall growth to an extent is the high debt levels. We'll see defaults. There will be high debt levels across the economy, be it the government, be it the corporate, or be it the individual level. and therefore it will take time for the consumption to bounce back. And it's, as I said, it's not only India or global world. About 90% of the global economies are into recession. This has never happened before any time, be it world wars, be it any other crisis. This has never happened before, that most of the countries globally are slipping into recession. At the max in 1930s depression, we saw this number bounce back to about 80%, but this time it's even further. This has led to destruction of jobs. Like US gives out great data in terms of its economy, and this is the jobs data out of US. The red line, whenever someone goes out of jobs, the blue line is what bounces first, because they file for claims with the government because they are unemployed, so that government pays them. And as they keep not getting a job, that blue line converts into a red line, which is continuing claims. They keep coming to the government for a paycheck in some sense because they are out of job. So if you see, the blue line had skyrocketed as the crisis started. And then we saw that translate into the red line increasing higher because those people were not able to find jobs. So this is still a very disastrous situation at hand in terms of jobs. If you see, across recessions, across timeframes where US economy had a bad period, this is nowhere compared to what we have seen before. This is significantly larger. And as we have seen the destruction in employment, that much longer time it takes for the economy to recover or the jobs to come back. So how this is impacting economy or central bank action or gold is that longer it takes for the jobs to come back, because we have seen it more or less in line with each other. So this time it's going to be even longer time than what we have seen in the past for the jobs to come back. And therefore central banks will have to continue to support the economy. And as they continue to support the economy, gold should do well. This is what we are talking about in terms of support to the economy, right? They have slashed interest rates like what we not seen before. It's been very, very aggressive. They started it even pre-COVID because economy was slowing even before the COVID crisis hit us, because we were in a kind of a very long but a slow recovery or slow growth period that we had seen in the US economy. And as it started slowing, they had started implementing rate cuts. But with COVID, they became very, very aggressive. They have slashed rates to zero. Many people are saying that it could go even negative, which could be because they had a paper or a theory called MMT, Modern Monetary Theory, which said that negative rates is not a bad thing. Therefore, rates could go even negative from here. And that's not only US. Like if you see, there have been rate cuts across the board. All the economies have cut rates significantly. And that is driving savers from these low rate instruments towards instruments like gold, because when these rates are so low that they cannot even surpass inflation, it doesn't make sense to own those or be in that fixed income instruments. Therefore, people kind of shift to assets like gold, which at least preserve their purchasing power. And therefore, we have seen a big jump in flows into gold from investors across the globe. Uh, as I said, low to negative rates are there in the global world. Low rates for sure. And in many places like Europe, we have seen negative rates, negative nominal rates. We are not even talking about real rates that is adjusted for inflation. Even on a nominal interest rate basis, the interest rates are negative in these economies. And it's not a small sum. It's about $14 trillion of debt is negative yielding today. Meaning if you have uh, uh, investment in that fixed instrument, then you are paying the owner, that is government or be it a corporate, money to park your money with that center, but with that government. So that really doesn't make sense. This was something unimagined a few years back, and it's now a reality. As we see these, all those being in these kind of negative yielding instruments are shifting to gold, and that is what is driving gold higher. It's a kind of financial repression that we are seeing, and therefore it does make sense for all these guys to shift their allocation from these negative yielding fixed instruments or fixed deposits to assets like gold. How this relates to gold is time and again we have seen, like be it in the 1970s or post the global financial crisis in 2008, whenever the real interest rates go negative in the US, we have seen gold do well, right? Uh, if you see on the left hand side of the chart, when there was a dip in 1975 and then again in 1980s, there was a big rally that we saw unfold in gold. Even in 2008, when central banks cut rates and there was some form of inflation leading to real interest rates going negative, we saw a big rally in gold. So is this time. The real interest yields are going negative, and that is one of the important driving factors in gold. That's one story. Central banks are cutting rates going negative, and therefore investors shifting to gold. Another part of this story is central banks again on a printing spree. They are printing money. What we know known popularly as quantitative easing is nothing but, in common terms, printing of the currency. They don't literally print currency these days. They just click a button and they produce millions, billions, trillions of dollars, right? If you see, it all started during 2008. They started printing money. They thought that any economic problem, any crisis that they see on the economic front, printing money is the solution. That's not really it, right? It is like, if you print a lot of money, it debases the value of the currency. And when it debases the value of the currency, there is one asset, or one monetary asset, I may say, that holds value, and that is gold. So it's not only US, it is Japan, it is Europe, it is China, everyone printing huge amounts of money. I would like to point out that even during good times, when we are seeing positive economic growth, they were still continuing to print money, right? Even after you see period from 2011 till 2016, 17, when growth rates were good, they were still printing huge amounts of money in trillions of dollars every year. And when this crisis hit, they thought that let's front load it. Let's print a lot of money so that this economic crisis that we are facing because of COVID disappears. And that's not the solution, right? You're really debasing currency when you do that. They have become a huge part of the economy today. If you see central banks, which were a very small portion of the economy earlier, now they have grown to about 50% of the economy, right? If the G4 central banks, if you see, their balance sheet size as compared to the economy is really at unprecedented levels, and they are becoming larger and larger portion of the economy today. And when we were talking about the money supply growth, the printing of money that US has done, it's gone nuclear in a way, right? Never before in history, from 1980s till now, we have never seen such high growth rates of increase in money supply. Even during 2008 crisis, we had saw it balloon to about 8-9%. Today it is 24%. The US money supply has grown by 24% as the central bank tries to support the economy and reduce the impact of COVID-19. Such high money supply really debases money significantly. The currency, the hard currencies that you own, it debases the value of that. And only currency which they don't have control over, which they cannot print, is one that continues to rise because this keeps declining in value. Other impact of this printing is a complacency in financial markets, right? If you see, since 2008, they have been continuing to print more currency. And if you see, stock markets have grown along with that printing. That really tells you that the stock markets are clearly supported by liquidity infused by these central banks. Are financial markets on a fundamental footing? I don't think so. It is based on liquidity. There is a disconnect that we are seeing between what financial markets are showcasing right now and what the real economy is. And therefore, whenever there is a sharp decline that will come, because at the end of the day financial markets will kind of reflect fundamental value. At that point in time, gold may again get revalued, because people will shift from these financial assets which are not based on fundamentals into assets which are based on fundamentals, that is gold. So overall, this paints a very bullish, very positive, very constructive view of gold. Low negative interest rates are not going away. They are going to stay for a very long time. To give you an example, post 2008, they continued with low rate for 6 years after that. To 2019, 2020 is a very significant financial crisis that we have at end. Economic deterioration is at unprecedented scale. So their accommodation is gonna stay for more longer than what we had seen even aftermath of the 2008 crisis. This debasement of currency is again very bullish for gold. People will kind of say that this doesn't make sense. So much printing, it just reduces the value of money that we own, and therefore shift to gold. And whenever stock markets correct or they reach unprecedented kind of levels from a valuation perspective, driven by the liquidity in stock markets, a bubble brewing there, will also make investors shift to gold, right? So we're gonna see incremental demand for gold because of these reasons, and that makes gold significantly bullish even at these prices. Second important reason is dollar weakness. As the crisis hit us, dollar appreciated in value, right? Dollar went up to close to 9,800 levels, and post things getting a bit normalized, and US central bank continuing to print more currency, dollar is losing ground. It has depreciated sharply to levels like 93, and that is leading more people to shift to gold. Any dollar weakness, it's positive for gold. Before we come to the main reasons for dollar, things don't look very stable, right? Across the globe. If you see in the US, what is the GDP growth rate that we have seen, and what is the growth in debt that we have seen? This makes it really unsustainable, what we are seeing today. The growth in debt has been really significantly large as compared to growth in GDP. And that really tells you this doesn't sound well, because all that we are seeing is increasing growth. More and more money or more and more debt is required to generate that additional point of growth in GDP or in economy. And that's really not sustainable, right? You need to have debt growing at lower levels and GDP growing at higher levels. That is more sustainable, more real growth that we are seeing. This is not real growth that we are seeing. And it's not only now. The gap has continued to widen from 1970s when the US took gold off the dollar standard. The debt has been increasing significantly without, and if you see before 1970s, there was no sharp gap that we had seen there. It was moving in tandem. And only when US took gold off the dollar, took dollar off the gold standard, that is when the disconnect happened. Debt growing higher, people were leveraging because they could get easy money from these central banks, borrow money from these central banks, and they could just do any kind of spending, even if it was unviable. And therefore, we have seen GDP growth rate not growing in that fashion as far as what growth we have seen in debt. And global debt is increasing to levels, very alarming levels that we are seeing. It's about 300 and more than 300%, 330% of GDP is what global debt stands at. This is truly unsustainable. Carmen and Renard had put a paper which said that above a threshold of close to 80% of debt to GDP ratio, your growth rates kind of keep coming down, right? It diminishes or becomes a burden on future growth. And that is what we are seeing. If you see growth rates earlier were in the range of global growth rates around 5-6%. Post 2008, it came to a normalized level of 3-4%. And I think post-COVID, it will become further lower on a normalized basis. Uh, how is this debt created? Is because central banks are allowing governments to borrow from by buying their debt, right? Central banks, and there are no other buyers who are ready to buy the government debt at such alarming levels. Central banks are pitching in and saying, we will buy your debt. We'll print more currency. We'll buy your debt. You can have as much debt as you want, right? The US government debt held by its own central bank is about 33%. For Japan, that number is 43%. And this is growing year on year. Central banks are making it possible for governments to have these reckless policies of running deficits and buying debt from them and make it impossible. US government deficit, as we've just spoken about, has been increasing year on year. Even this year, it's going to be significantly large deficit. Even last year, they had a deficit of $1 trillion, right? So they are spending recklessly, running deficits, central banks making it possible for issuing of so high debt, right? And this deficit that doing year on year is making the debt to GDP ratio at a level which doesn't look sustainable, right? Uh, this is being questioned. This high deficits every year, the increase in debt every year is making investors holding US treasuries question whether we should be staying with the dollar asset or should we move out of dollar asset, because a dollar is really on an unsustainable footing. And this is going to be a question running on holders of US assets, right? Uh, all the printing that we have seen has continuously debased the gold that they have back as a backing for the dollars that they print. In 1970s, when they took it, this ratio was about 140 tons per $1 billion of currency in circulation. Today, it's come to very, very minuscule level. It is just 4.5 tons of gold that they have per $1 billion of currency in circulation. So they are not buying more gold. They have that gold constant. They're printing more currency, which is leading to deterioration in this ratio, right? So there is no intrinsic value or the intrinsic value, whatever they had to this dollar is continuing to decline, right? And can this lead to a collapse in the dollar in the form that we know today? Dollar is a reserve currency today. Will the dollar not be used as a reserve currency going forward? Because the things that we are seeing for the dollar or for the US economy are really looking unsustainable, and therefore its dominance can really come to an end. We have seen various reserve currencies, and this doesn't look like a sheer coincidence. We are seeing things shape up in this manner going forward. Most reserve currencies have uh, collapsed as a reserve currency in about 100 years. There will be plus and minus, but average is about 100 years. US dollar in 2020 completes 100 years of being used as a reserve currency. So will it be true for the dollar? Will dollar cease to be a reserve currency? Factors are shaping up for that. There is kind of no alternative. There is no other reserve currency kind of capable to dethrone the dollar. But time will say what happens to the dollar. Will it persist as a reserve currency or not? One thing that we are seeing, that unsustainability in policy making in the US is leading many to move away from dollar. They are diversifying away from the US dollar. Central bank reserves, which used to be in excess of 70%, has come down to about 60% level. And I think it will further decline. Central banks will further diversify away from the US dollar as a reserve of their holding. Another thing that we are tracking is the SWIFT payments, the global trade payments that we see, payments for trade and services. They happen through a US system called SWIFT. So we have seen a decline in share of dollar share in SWIFT payments, which was about 45%. It's come down to about 40%. So we have already started that move as people shift trade away from dollar being used as the currency for trade. They are moving to other currencies. They are using more bilateral trades, and therefore US share is continuously declining, and it will further decline going forward because the factors or policy making that we are seeing in US is making everyone jittery. Uh, there has been a significant shift from central banks towards how they see gold post 2008 crisis. They have been what they were initially sellers of gold. They have become big buyers of gold. They have been buying significant quantities of gold every year. And even this year, they have bought significant quantities of gold, and they will further buy gold as things stabilize. I think they will want to diversify their reserves into assets like gold. Uh, as we see they are moving into gold, they are reducing their dependence or moving away or reducing the share of the dollar assets, right? If you see these red bars, the huge red bars, they have been continuously declining their share of US dollar reserve. There will be small tick marks in green, but that could be just a, but if you see a trend, uh, it's continuously been negative, moving out of dollar. And this chart sums it up, right? They have the green line is moving downwards where they are reducing their share of dollar, and the orange line is moving higher, which tells you they're increasing their assets in gold. This is a trend we think will continue going forward and support gold markets further. So US dollar is on an unsustainable footing. There are rising debt deficits. Dollar dominance is clearly under threat. We are seeing different signs of trade payments, of it being as a reserve is declining continuously. As dollar weakens, because if people shift out of dollar, it will weaken the dollar, and that will be favorable for gold because gold and dollar move in opposite direction, right? And if that will tell if dollar will weaken further, gold prices will move up further. Central bank support is going to be another pillar for gold prices. Third important reason is long-term rupee depreciation that we have seen. That adds to the gold price return in INR, right? If you see, since 1970s or 1973 till 2020, rupee has depreciated by about 5% per annum. So 5% of gold returns that you have seen is coming from the rupee. There is no reason that tells us that this is structurally changing. The growth rate may be different, maybe 3, 4, 5%, but rupee will continue to depreciate, and that will bring another form of return apart from the dollar gold price return that we have seen looks attractive. This is another reason that will add to gold price returns in rupee terms. So this is one factor that many have exposure to gold, because as rupee depreciates, you lose your purchasing power, and gold helps you as because gold increases to an extent that rupee depreciates, right? It's equal proportion. If gold rupee depreciates by 10%, gold price in INR terms will at least increase by 10% because of the rupee contribution, and whatever the gold price return that we see in dollar terms, that will be an add-on factor. Number 4 reason, despite so much buying that we have seen in gold across the globe from in ETFs from investors, gold is significantly underowned even today. We have seen record flows in ETFs this year. In just 6 months, we have surpassed yearly highs that we have seen before. So it's a new high we have already made. It's a record high of $23 billion. In 2016 was a previous high to about $40 billion this year. So whatever decline that we have seen in physical buying because of lockdowns has been to an extent compensated by the physical, by the investment flows that we have seen in gold. Despite such high buying, where are we in terms of gold ownership? This is a share of gold ETFs vis-a-vis all other ETF out there. Before the 2008 crisis, it was closer to 2%, which went up to about 8% after the global financial crisis. Flows came in. Then it declined because of gold sell-off, and investors moved out of gold and moved into risk assets. And it was back to 2% or less than 2%. And now, as we are seeing more buying from investors, it's inching higher from 2% to the 3% mark. So we are nowhere close to the peak that we had seen in 8%. So that doesn't, that tells us that other assets have gained a lot more flows, and it's time for gold now to get some of the flows back, right? So we will see more incremental buying from investors into assets like gold ETFs, and we will see this increase. So it's nowhere close to the higher levels. This time the case is even more bullish and more reason for investors to move into gold, but we are not seeing that kind of flows, though it is record flows, but we are nowhere close to what highs that we have seen. So there is a lot more scope for investors to buy more into gold ETFs. And overall, if you see, as you might have heard from many financial experts, financial planners, that gold should be about 10%, 10 to 15% of your overall portfolio. If you see total global net worth, which stands at about $360 trillion, gold is just about 2.5% of that. So there is significant scope for investors to allocate. Gold is significantly under-owned. Any small shift of investors moving out of other assets into assets like gold, because gold's importance has only increased, and people have realized after each crisis that gold is a valuable asset in the portfolio, they are increasing their allocation. So if this were to shift to 10%, gold will just go stratospheric. Gold will just move significantly higher than what levels we are seeing today. So any small shift will also be incrementally more positive for gold. Gold has crossed the all-time highs. Today, it is standing at close to $1,950 an ounce. So it has surpassed the previous peak of 1921. It is at record high. Investors are questioning whether this is a true bull market in shape, or is this a bear trap, or is this the highs that we have seen and gold will fall from here? We don't think so. It's like a bull market in place. As we have seen, the factors are still very, very positive, very, very constructive, all saying that gold should head higher. Compared to previous bull markets that we have seen, be it the 1930s, 1970s, the 2000s, or now, where are we? What kind of growth rates that we have seen in the previous bull market? And where are we as compared to the previous bull markets? Like in the 1930s, 1970s, gold had increased by about 400%, right? In the 2000 bull run that we had seen from 2000 to 2012 before gold peaked, we had seen an increase of about 500 to 600% in gold. What we are seeing today is not even a 100% increase. As gold bottomed at closer to $1,000, we are closer to 2,000. So it is still shy of 2,000. So it's not even 100% increase. And that tells us, as compared to the previous bull runs, there is still bigger scope for gold prices to go up, right? As compared to the 2000 bull run, if you were to put this into perspective, we are still at 100% as compared to the 500% that we had seen. So as comparison to previous bull runs, that tells us there is still more scope. Factors are positive than ever that we have seen. That tells us that gold should head higher. So where could gold prices go? So there are various forecasts from various global banks on gold prices going higher. Today we are at $2,000, which is about 54,000 rupees per 10 gram price. If gold prices were to move to 2,400 and rupee to depreciate, because at the end of the day, gold prices are nothing but a combination of gold in dollars per troy ounce and the USD INR rate, right? So if gold were to go to 2,400 and say rupee to depreciate to 85, then you could hit that magical figure of 75,000 easily, right? So depending on where the gold price goes and where the rupee goes, that's going to be the gold price that you would see. So gold remains an under-owned asset clearly. There is significant potential upside for the metal from a price perspective, from investment flows. So overall, things are looking very, very positive. What could go wrong? if say you are entering gold at these levels, what could really go wrong? I think two reasons. Going overboard, we see investors usually chase returns, right? Uh, and when they buy an asset because of the positive outlook, they tend to go overboard. Uh, so one important thing to always remember is asset markets go through cycles. This is a chart where each asset is ranked by their performance in that particular calendar year. So in some years, we have seen equities do well, some years bonds do well, some years gold do well. So each asset is there for a purpose in your portfolio. So have a inclusion of all assets in your portfolio. Uh, Proportionately, you could be higher or lower in that asset for a particular time being, but don't go overboard. We recommend that a 10 to 15% allocation is a good allocation for gold. So despite the outlook that we have shared, if you are at that level, be with it. If you're not there, add it. And if you're above that, then you may keep, if it is a small increase, then you may keep it. Otherwise, you may reduce it. So gold is really, as I said, each asset is there for a purpose. Gold is there for diversification, right? Whenever we have seen significant fall in stock markets, gold has done well. Even this year, when stock markets fell, gold increased in value, right? So this is an important role that gold plays in your portfolio. Uh, if you see from 1980s, a third of the time gold has done well as compared to equities, and that is why you need to have gold as an asset in your portfolio, a third allocation in your portfolio, because it has 16 out of 40 times, a third of the time, help your portfolio. So always have a diversification in your portfolio and have gold as an important diversifier. Gold also helps from a portfolio perspective. For example, if you had just an equity portfolio, you would have higher returns. Right? You would have returns like 11.6% since 2004 till today. But when stock markets fall, that could even half your value, right? The maximum fall that we have seen in equity markets was 56%, as highlighted in the equity column. But if you had a mixed portfolio of equity, debt, and gold, you would just lose out a small bit on returns, right? From 11.59 to 10.36. But look at the risk that you're reducing. From 56% fall, you come to a fall of 21%. And that is the role that gold plays, minimizing the shocks that you have on your equity portfolio. One important thing that we have seen is, and all investors need to bear in mind, that one thing that is constant is inflation. Your cost of spending increases year on year. From 1990s, your basket of consumption for your household would have been about 23,700 rupees. Today, that the same consumption basket has increased to 4,27,000 rupees. So that's an increase of about 10.1% every year on your cost of spending. If you had gold in your portfolio, you needed 70 grams of gold at that time to get your consumption basket. Today, you need 82. So 10.1 versus 9.5. So it's almost match your cost of living increase. If gold prices move up further, it will nearly match that number of 10.1%. Equities have helped because they've grown at 14.1%. So that has really helped your portfolio. But at the same time, they are equally volatile, right? Therefore, you cannot have all assets in equities. If you invest in equities, you have to have an allocation to gold. And fixed deposits have been clearly a losing proposition for investors, right? They have only increased by 5.8% adjusted for taxes. So that has not really kept pace anywhere closer to the 10.1% increase in your spending. You need fixed deposit for that emergency fund that you build. Apart from that, it's been a losing proposition. So if you have excess money lying in fixed deposit, you need to shift it to assets like equities and gold. So gold is more than just a tactical allocation. It is a part of your portfolio. So no matter how dumb it may sound, have an allocation to gold, right? Have a 10 to 15% allocation to gold, because that is an optimal level, beyond which the utility function of gold from a portfolio perspective keeps declining. Number two reason what could go wrong is, very importantly, fraud gold, right? we have seen there was a massive scam in China where about more than 83 tons of gold was counterfeit gold, of fraud gold. And that really tells you that you need to be very cautious when you buy gold. Even it was reported that Chinese central bank could have about 4% of their reserves as fraud gold. So that even if the Chinese central bank could not go unescaped, how about you buying gold and getting an impure gold in your hands, right? And even in India, it has been always a concern. There have been fake gold bars, machines seized out of Zaveri Bazaar, hallmark gold jewelry have been questioned. Uh, Biggest refiner, MMTC PAM of India, has when they refine scrap gold, they have said that about 15 to 20% of gold is found to be impure. So when you buy physical gold, it's always a risk to get an impure gold in your hands. So how do we protect when we buy physical gold for you in our funds? How do we protect and how do we ensure that gold is indeed gold and it's pure gold? Uh, we only buy gold which is 24 karat, and that too from LBMA accredited refiners. LBMA, to introduce you, is the global authority on precious metal. They have stringent checks as far as the financials, as far as the process that the refiners have to refine the gold. They do surprise checks on those refiners and to ensure that these refiners are adhering to their standards, right? There is a refiner certificate that we get. We only import gold through authorized channels. We don't import gold from unauthorized channels. There is an advent of smuggled gold coming into India. We don't even touch that. We will not even buy anything that's not coming officially in India. We store gold in professional vaults, which have all the latest gadgets and procedures in place, all the security in place in their vaults. Uh, Once the gold enters the vault, and if it has moved out of vault, it cannot come back in the fund, right? The vaulters will not accept it. So there is a trail check of where the gold has traveled, where it is coming from. After import, has it gone out of the vault? If it has gone out of the vault, it cannot come back in. So we have an entire trail of where gold has moved, and therefore that tells us if there is any chance or any probability of that gold moved into unofficial channels and therefore manipulated. There are audits on gold. There are statutory audits as mandated by SEBI twice a year. The month custodian, which is Deutsche Bank, audits the gold every month. We at Quantum, led by the fund management team, goes to the vault every month to check each and every gold bar held by the fund. Each and every gold bar is taken in our hands and verified. Uh, all the gold is completely insured by a comprehensive insurance policy, which also includes a terrorism insurance. So we don't take any chances. It is a very, very comprehensive insurance cover covering all risk that we have. Uh, the most important thing, despite doing all this, could there be a chance that the gold could have been manipulated, right? So how do we ensure that we even don't leave that stone unturned is by doing a purity test of the gold that we hold in the fund. So we hire an independent agency who is a material testing agent. They test gold. They have been in that business for a fairly long time. They come to our vaults, they check the gold, each and every gold bar, measure it for purity, and give us a purity certificate. And to this date, every year we have found that all the gold that is held by the fund is indeed gold, indeed pure. And this is what we get feedback from the vaulting guys is you are the only guys who do it. So this is what only Quantum does. That is what we hear from the vaulting agents who store the gold. Uh, and therefore, this is one important way we ensure that gold is indeed gold. Gold is 100% pure that we have, and there is no element of impure gold that we have in the fund. So, which is the best way to own gold? There are various ways that are there: physical gold, gold contracts. So let's look at each of them. Like coins and bars were an important form of gold buying previously, before the advent of good ways to buy gold. And these are very inefficient ways of buying gold. The coins and bars bars are very price inefficient. There are markups at all levels. There are wholesale markup, retail markup. There are purity concerns. When you sell it back, there are buybacks issues. There are discounts. So it really makes it an inefficient form. Plus, there are issues with storing these in lockers, because we have seen many times lockers have been things have been stolen out of lockers. Even if you want, it will be kind of impossible to insure this. Even if you insure, it will come at an exorbitant cost, which is unlike for us as institutions. So this is, as compared to gold ETFs or gold funds, really an inefficient way of buying gold. Gold stocks, many say that gold stocks are in leverage to gold and therefore they will give me more returns. But gold stocks are also in leverage on the downside, right? Whenever gold price falls, they'll fall more, right? And they are stocks first and gold second. More very important thing to remember. When equities market falls, even these stocks fall despite gold prices rising. So that does tell you that these are not the diversification that you're looking for, right? So they are not like a genuine form of gold exposure. You are better off with a pure gold exposure as opposed to gold stocks. Another thing is gold futures contract. I think it is highly complex. There are margins involved. There is rollover to be done at the end of the contract. There is leverage involved, so that makes it more risky. They're suitable for short term and who understand those markets, but otherwise, I think they are not for retail investors as an allocation. Another important way that government has unveiled over a few years back is the sovereign gold bonds. They give you exposure to gold prices, they give you interest, they are tax efficient. But if you have to exit, the secondary market is very, very liquid, illiquid. So they trade at significant discounts. We have seen over the past, they trade at a discount of somewhere between 5 to 15%. And there is a logic behind why they will trade at a discount. If you enter that, getting exposure to sovereign gold bonds, they are very, very liquid. That is to be kept in mind. Another important thing is they are liability of the government, right? They are not backed by gold. Government issues that and they will pay you the gold price on maturity, but they are not backed by gold. They are a liability of the government. People generally tell us that they buy gold because they don't trust the system. Now, again, buying gold from the same system doesn't make sense, right? So there is a philosophical mismatch of buying gold and buying a sovereign gold bond. So I think the gold ETFs and gold funds are the best financial innovation that we've seen over the last decade, because it allows a retail investor buying small denominations of gold at a very, very wholesale price. And what prices we are talking about is prices where tons and tons of gold get exchanged between a gold producer and a bullion bank. So those kind of wholesale efficiencies, gold ETFs bring to a retail level at a very small denomination. So you don't pay a high premiums that are associated with buying physical gold. There are no making charges. It's extremely liquid, trades very close to real market fair values. No purity concern because the fund house takes care of it. Plus you get a GST credit. So when you buy physical gold or be digital gold, 3% is GST on gold. You end up losing that entire 3%. Whereas mutual funds being pass-through vehicles give you that offset benefit and pass that offset benefit to you. So you don't lose out on that GST credit. So I think given that gold ETFs and gold funds are the best place to invest, let me introduce you to the Quantum Gold Saving Fund. It's an extremely efficient way to invest in gold. It's very, very price efficient relative to the traditional forms of buying gold that we are used to. There are no hassles of purity, storage. It's all completely insured. You can buy smaller denominations to any unlimited amounts that you want. And most importantly, it is open 24/7. You could literally transact 24/7. During the lockdowns, we have seen many people, because of the crisis that they were facing, they wanted to liquidate their gold holdings because gold is for a rainy day, right? And when they wanted to liquidate their gold holdings, they were not able to do it because everything was locked down, everything was shut, no shops were open. So that was an issue that these investors who were wanting to liquidate gold were facing. So had they been in the gold funds or gold ETFs, they could liquidate in a fraction of a second, right? They could just sell it whenever they wanted. So this is an important trade that you need to keep in mind, that quantum gold saving fund is virtually open 24/7. So Ghazal, with that, I think
Thanks.
I have given insights on gold, how we see gold, and over to you.
Thank you, Chirag, for the detailed presentation and for sharing your insights on gold. Um, we have some questions that have come in for you, so let's get started with those.
Sure.
So should I buy gold or should I settle for silver? And any plans to launch a silver ETF?
See, silver, you need to distinguish between gold and silver. What kind of elements are these, right? Gold is a monetary asset. Silver, if you know silver, about 70% of use of silver is for industrial uses. So silver, in a way, if I have to translate the silver characteristics, it is half copper, half gold. So it is not pure gold. It gets pushed when gold prices move up, and it's kind of extremely volatile as compared to gold. Uh, when silver will do well, when your economies do well, when your stocks do well. So you're not getting the diversification in silver as you get in gold. So from a gold silver, if I have to choose one, I will say be with gold. There will be phases when silver may outperform gold, but it is, please remember, you need to exit your time your exits very promptly, right? Very accurately to gain that advantage in silver. It moves up faster. It will even fall faster as compared to gold. So be careful when you invest in silver. It's a double-edged sword. uh, uh, when it comes to diversification of your portfolio, be with gold as opposed to silver. Uh, so be with silver. In as far as silver, be with gold. As far as the silver ETF is concerned, there could be some that may launch. Some fund houses may launch it. There were issues with custody, but I think that is now sorted. So you could see a silver ETF potentially going forward. Uh, uh, but one thing to remember when you choose between gold and silver is uh, silver is extremely volatile. The bid ask spreads are very wide in silver. Uh, uh, when it comes to the cost of storing silver, they are very high. So from all that perspective, even a gold ETF works better as compared to a silver ETF. Um, and one important thing that investors kind of track is the gold silver ratio. So if you had seen gold silver ratio, gold had increased significantly and silver was not doing so well. It had crossed 100 mark. It's come down now as silver has started to catch up with gold. Uh, but if you see, there have been structural changes in that ratio over a period of time. Earlier, it used to be in a different band between somewhere around 30 to 70. Then it moved higher from a band of about 40 to 80. And I think now again the band has shifted because of the monetary recklessness that we have seen from the central banks. So don't expect that gold will come or gold silver ratio will come to the same levels or same lows that we have seen previously. I think there has been a structural shift in that ratio. So silver may have some headroom to run, but when it comes to choosing one of the two, I will always choose gold.
Sure. Uh, Chirag, will the return of the quantum gold fund perfectly mimic the price of gold?
Uh, so quantum gold fund will mimic, if you see historically, it has mimicked the price of gold and it will continue to do so. We do not take any calls on gold prices. We try to stay as close to 100% invested at all times. What could be the differential between the gold price and the quantum gold fund returns will be uh, expense ratio and a small tracking error. To give you an example of tracking error, our since inception tracking error has been 0.005. So if you translate it into the annualized tracking error, it becomes 0.081. So it is very low. So barring the expense ratio and barring the tracking error, it will perfectly mimic the gold price.
Sure. So the next question is, I buy gold from the local market. How can I know for sure that, I have been sold pure gold or have I been sold fraud gold?
So as an investor, I think it is very, very difficult. I mean, you might have to do a purity test to identify whether it is pure gold or not. There is hallmark gold that is available, but again, there have been enforcement issues on the hallmarking. They are trying to uh, make it proper, make it in line to what it should be, bring an onus on the seller. But so far, it's been a buyer beware kind of approach that has been there, and therefore it is very, very difficult to know whether the gold is indeed pure or not unless you get a purity test done. So when, because this has been a significant issue for physical gold buyers, and now as new forms have emerged, I will say that a traditional form of physical gold buyers need to shift to more efficient forms of buying gold, like gold funds or gold ETFs, and therefore you can be sure that the gold that you are buying is indeed pure gold.
Okay. So if an investor is invested in the quantum gold fund, at the time of redemption, can he ask for gold instead of cash?
Yes, the straight away answer is yes. You can ask for gold, but there is an criteria that needs to be fulfilled, which is nothing but not an distinguishing between investors, but it's just that when we buy gold to be in the liquid wholesale market, we buy 1 kg gold bars. So if your holding is equivalent to 1 kg, which translates to about 2,000 units of the quantum gold ETF, then you can take physical delivery of the gold by surrendering the units that you have. So yes, that is possible, but the threshold today is about 1 kg. So if you have units worth 1 kg, then you can take physical delivery of the gold.
All right. Is it better to invest in gold through staggered payments or a lump sum investment?
So, I mean, lump sum payments always allow you to average your cost over a period of time. So I will just say, depending what your allocation is, I think I will suggest an approach. So if you don't have any allocation to gold today, then I will suggest that you buy 50% now, at least 50%, given what we are seeing in terms of factors for gold prices, at least 50% now. And then the rest 50%, you can stagger it over a period of time. If you already have a sizable allocation to gold and if you just want to top it up, then you could do a staggered approach. Uh, Given factors are looking positive, you could buy gold even now. Uh, the only thing is there will be volatility in financial markets, which will also translate into volatility in gold. So there could be an advantage to that rupee cost averaging, but at the other end, you have a positive gold outlook, factors looking positive. So buying a lump sum now will also make sense.
Sure. The next question is from an investor who owns 800 grams of 22 karat gold, and he wants to know which is the best option out of the three. Should he sell now and invest in equity mutual funds? Should he sell now and invest in gold mutual funds? Or should he hold on to the gold jewelry?
So if you have already chosen and if you have already kind of chosen an inefficient form, it doesn't make sense to switch right now. But I will say that incremental, whatever you buy, you should invest through gold funds. Second is, depending on your allocation today between gold and equity, you need to choose whether you need to sell or not. We will suggest that apart from your reserve cash that you say keep about 24 months or 36 months, depending on how comfortable you are, rest could be split between 80-20. So if your split is not in 80-20 and more towards gold, then you can sell some gold. But otherwise, I will suggest that if you have that adequate equity exposure, you need not sell your gold right now. Keep it in the same form today, because it doesn't make sense to switch now. But any incremental buying that you do of gold, please don't do it in form of jewelry because it is very, very inefficient. You should buy gold funds or gold ETFs.
Sure. So gold prices have crossed a milestone. So what could lead to a fall in gold prices at this juncture?
Yeah, that's a very, very important question and a very good question. So factors look positive for gold, right? What could cause the gold prices to fall? One important, it has to be a very high growth rate that we return to, uh, very, very stable inflation, very controlled inflation, and central banks kind of moving onto an increase in interest rate trajectory, and not doing these money printing. So it has to be a combination of all these. A high growth environment, stable or controlled or low inflation, and interest rates starting to inch higher, and central banks discontinuing the printing that they're doing today. So if these set of factors come in a combination, then I think that could lead to a fall in gold prices. All four of these look unlikely today, and therefore the probability of gold pricing falling is lesser as compared to gold prices increasing from here. So it's an unlikely scenario, but if this scenario unfolds, it could lead to a fall in gold prices.
Okay. Is it advisable for investors to get into gold at the current levels?
So I will suggest yes, you could get into gold in current levels, but I will suggest that you don't go overboard. Despite the very, very positive outlook that we see for gold, don't go overboard. Have a 10 to 15% allocation in that range of your total portfolio. And if you don't have that, even buying at these levels is not a problem. You should buy gold. It is very, very important allocation in these uncertain times that we face today. So if you don't have the allocation, please buy gold.
Sure. So would you say investors can be assured of the purity of gold held in the quantum gold ETF?
Yes, we are very sure of the purity of gold that we own in the quantum gold ETF. Uh, the important fact being, we do a purity test of the gold every year. We have stringent policies in terms of kind of gold that we accept. We do a monthly checks ourselves. So all these lead us to a conclusion that yes, we are sure of the gold that we own in the quantum gold fund. Most important being, and only with quantum, is the purity check that we do. I don't think any other fund houses, that's what the feedback that we get from the vaulting guys who store all the gold. So all the gold of all the funds lies in that vaults. So they have told us that no one else does it. And given that we do it, that makes us sure, because it's kind of a foolproof method that we employ to identify that the gold is pure or not. So yes, we are very sure of the purity of the gold that we own.
All right, Chirag. So with that, we come to the end of the Q&A. So thank you again. And over to you, Ronak.
Thank you, Chirag Ghazal, for sharing those extremely valuable insights. I'm sure viewers will immensely benefit from your views. Viewers, in case if you have any queries on gold or want to know more on gold, reach out to Quantum Mutual Fund. You can reach out to Quantum Mutual Fund on customer care at quantumamc.com or give a call on 1 800 209 3863 or 1 800 223863. You can also SMS on Quantum to 92432 3863. You can also buy quantum funds on registered online investment platforms. Viewers, hope you enjoyed this web summit and thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.